You've probably used them this week to sign a lease, an offer letter, or maybe a vendor contract. They are so incredibly ubiquitous, they've actually become a verb. Welcome to the EDGAR Brief. Today, we're cracking open the Q1 fiscal 2027 10Q filing from Docusign, ticker symbol DOCU, which covers the 3 months ending April 30th, 2026. We're going to translate this incredibly dense 60-plus page SEC document into plain, everyday English. And look, I want to hook you right away with this number, $830,235,000. That is how much revenue Docusign brought in over just a single 90-day period. It's massive. Quick note before we get going, though, we're an independent explainer, we're not affiliated with the SEC, and we are certainly not your financial advisors. We use AI to help summarize these filings so errors can happen. Always verify on sec.gov before making any money decisions. Okay, here is our roadmap for today. The business model, the scorecard, the moat check, reading between the lines, key red flags, and finally, the bottom line. Let's dive right in. Section 1. The business model. How Docusign makes money. Before we get dazzled by the millions, we really need to ground ourselves in reality. To understand any business, you have to ask the fundamental questions, right? What do they actually sell? Who do they sell it to? How does the money come in? And where do all those dollars go? Think of Docusign as basically a digital toll booth for corporate agreements. They sell software that digitizes the entire contract process, from creation to signature, all the way to storage. And they sell to everyone, from tiny mom-and-pop shops to the absolute largest global enterprises. Once a company integrates Docusign into their daily workflow, they pay a recurring subscription fee just to keep their business traffic moving smoothly. So basically, Docusign is a digital toll booth that makes money by taking a recurring fee to let contracts pass through quickly and legally. Section 2. The scorecard. Numbers that matter. Let's check the actual financial health of this digital toll booth. First question, are more dollars walking in the door? The short answer is a solid yes. Q1 revenue hit $830.2 million. That's a 9% increase year over year compared to the $763.6 million they did in the exact same quarter last year. So the toll booth is definitely getting busier. Now, we need to translate a vital piece of financial jargon really quick. Free cash flow. This is the real cash left over after a company pays its bills and buys its equipment. You see, accounting profit, well, it can sometimes be a bit of a fiction. It gets heavily influenced by non-cash charges like stock-based compensation. Cash flow, however, that's reality. And what's really interesting here is the sheer size of the gap between these two numbers. If you just look at their GAAP net income, their official accounting profit, it sits at a modest $78.1 million for the quarter. But if you look at the actual cash they generated from operating the business, which was roughly $321 million, and subtract the $32 million they spent on property and equipment, you get nearly $289 million in real, cold, hard free cash flow. Guys, this is a phenomenal cash-generating machine. And here's a big reason why they generate so much cash. Their GAAP gross margin is 79.4%. Think about that. That means for every single dollar of software they sell, nearly 80 cents sticks to the company before they even have to think about paying for sales reps, research, or office rent. That is the absolute beauty of a mature software business. Section 3. The moat check. What protects them? So why can't a competitor just spin up a cheaper e-signature tool and crush them tomorrow? Well, because Docusign has built two incredibly deep moats. First is brand power. With nearly 1.9 million customers globally, they are literally the Kleenex of their industry. People just say, just Docusign it. That level of trust is incredibly hard to replicate. Second is switching costs. Docusign isn't just a website you visit. It's deeply, deeply integrated into the background of massive business systems like Salesforce, SAP, and Microsoft Copilot. If a company wanted to leave Docusign, it wouldn't just mean canceling a subscription. Actually, it would mean ripping out the plumbing of their entire sales and HR departments. Customers would absolutely scream if they had to leave. Section 4. Reading between the lines. Management's discussion. This is where we analyze the management's discussion and analysis section to see what story the executives are really trying to tell us. And right now, management is putting all their chips on the table with AI. CEO Alan Thigen is heavily hyping their new Intelligent Agreement Management, or IAM, platform. They're pushing this narrative that Docusign is no longer just about signing documents. Instead, they're using AI, like Anthropic's Claude and OpenAI, to review contracts, flag risks, and track obligations completely automatically. And they boast that 40,000 customers are already investing in this roadmap. But here at the EDGAR Brief, we like to read the silences. And the hard numbers? Well, they tell a slightly different story right now. Despite all the massive AI hype in the commentary, 98% of their $830 million in revenue is still just boring, predictable subscriptions. And as the filing itself notes, the substantial majority of this comes directly from their traditional e-signature product. So the AI platform might be the future, but plain old e-signatures, they're still paying the bills today.
Section 5. Key red flags. What could go wrong?
Now, we always skip the legal boilerplate in Item 1A about asteroid strikes and alien invasions. Instead, we focus on the actual specific threats management highlighted for this quarter. First, as we literally just saw, they explicitly warn that they rely heavily on that single core e-signature product. If growth slows down there before the AI platform really takes off, revenue takes a major hit. Second, they're actively changing how they charge customers. They're rolling out new pricing models for the IM platform, shifting to a user-based subscription with transaction add-ons. Look, changing pricing is always a massive execution risk. Customers might just balk at it. Third, they're shifting away from a purely direct sales approach to rely way more on partner channels and digital self-service. Whenever a company changes its sales engine mid-flight, you've got to watch closely for turbulence. Section 6. The bottom line. Verdict and sign-off. The verdict here is pretty clear. Docusign is a massive software cash cow with an almost impenetrable moat of 1.9 million deeply integrated customers. Their gross margins are beautiful, and the real cash they generate is just stunning. But the main thing to watch is whether they can successfully evolve past just being a simple e-signature tool. Can they convince this massive customer base to pay extra for their new AI-driven contract management features? So here are the 3 specific things you should track when the next quarter's 10Q drops. Number 1, does that 9% core revenue growth rate hold steady? Does it accelerate or does it dip? Number 2, we need real revenue adoption numbers for the new AI-IM platform, not just vague phrases like customers investing in the roadmap. And number 3, look closely for any management commentary on customer pushback or churn resulting from those new pricing models. It leaves us with a fascinating question. Will DocuSign remain just a verb for signing a PDF, or will it successfully become the AI brain behind every business contract in the world? That's your EDGAR brief on DocuSign. Remember, this was an explainer of the source material, definitely not a recommendation. Go read the original on sec.gov if anything piqued your interest today. Thanks so much for learning with us, and I'll see you in the next filing.